Welcome to the NEWSMAKER. IFM Investors is the largest pension fund-owned asset manager in the world with 80 billion Swiss francs in assets under management. And it has just launched its operations in Switzerland. I'm now joined by Brett Himbury, the CEO of IFM Investors. Thank you so much for joining us, Brett.
Thank you, Martina.
First of all, Zurich is your 9th global location. Why did you pick Zurich?
We have a great client base here already in Zurich, and in essence, we want to continue to build on the strength of that relationship that we have with those pension fund investors. That's the primary reason. Otherwise, there's a really challenging environment for investors, and we think there's some things that we can do to help people in a very challenging environment. And finally, we will look to more closely at investment opportunities in the country and around the region. But first and foremost, it's strengthen those relationships with our existing clients here.
And what, Brett, took you so long to make this decision and move to Switzerland?
We are long-term patient investors, Martina, so we do things in a very considered and deliberate way.
It's like good wine, right? Things
right, yeah.
take a long time.
We get better with age. So why did it take us so long? I mean, we've been in the country, supporting and working in the country, fly in, fly out for quite a number of years. Our business is still relatively young. We're about 25 years old. We globalised the business about 12 years ago. So this is just another step in that global evolution.
Now, was there a specific strategic motive behind this move?
Yeah, look, the motive really is driven by the members of pension funds. And our view is that those pension funds are facing probably one of the most difficult environments that they've faced in 30 years. So I say that with all seriousness. It's a very tough financial environment. It's a very tough political environment. So there's lots of different challenges. So why now is it strategic? It's really to try and do more to add to the returns of working people in this country and around the world, and frankly, also in investing our capital, improve society. We like to take a long-term view in improving enterprises, which grows returns. So a dual objective strategically of adding to investors' returns, particularly members of pension funds here, and adding to society, that dual focus.
But don't you think that there are enough players here in the market already and that the Swiss market is saturated at this point?
It's very competitive and there's some large and really successful fund managers. Having said that, there's nobody like IFM. And now, I don't say that lightly, and I'd imagine some people might even view that with a degree of cynicism.
So what do you think is your key asset and your competitive advantage?
Yeah, well, the main advantage is that we are owned by pension funds. So we're owned by 27 pension funds, and they own us and established us just to think and act solely in their members' interests. So whilst we have shareholders, our original reason for being was to focus be unrelenting in our focus on driving returns to investors. That's our primary source. We now also have just a group of wonderful aligned institutional investors in 19 countries, including, of course, Switzerland, and a world-class team. So you put those three things together, first and foremost, our ownership model, the culture that drives, terrific long-term aligned institutional client base, and, you know, like all of us funds managers say, a world-class team, but we have. Those three things are very, very powerful. So we're very happy to enter a competitive market, thinking and believing that we can add to that competition.
But you also have a lot of big insurance companies like AXA and Swiss Life that are also offering now asset management products. Yep. What kind of competition does this bring to traditional asset management companies?
Well, there's all sorts of different models, as you say, bank-owned, insurance company-owned, employee-owned. But again, there's not too many, well, to our knowledge, there's nobody that it's actually fully pension fund-owned. So what does it bring? It brings choice, you know, and when pension funds around the world are looking for, you know, opportunities to invest, as well as the asset allocation decision and other regulatory issues, they're looking to potentially look at a range of different ownership models, because ownership impacts culture, and culture impacts the decision-making of investors, and that in turn impacts the returns. So this is another and complementary and competitive ownership style, which drives a different motivation, which we think absolutely contributes to investor returns.
Now, to tell our viewers, who are these pension funds that own you, and also what kind of pressure does this put on your shoulders because you're owned by pension funds of countries.
Yeah, very good point. So who are those owners? First and foremost, they are 27 Australian industry funds. So funds that focus just on the returns to the members. They have no profit motive as an institution. Their sole motive is to drive returns to their members. So 27 of those funds own us. What pressure does it put on us? I mean, the pressure is really to deliver returns. We don't face the same sort of shareholder pressure to drive funds under management and revenue and profit as a funds manager, although we do that modestly. But our pressure from our owners, and it's the same as the pressure from our clients, which is we want returns to our investors out of investing in infrastructure, debt and equity and listed equities and private equity.
But it's getting increasingly difficult and tough now to generate profit, right? Because you have a low interest rate environment, aging populations and demographic growth around the world. So how tough is the environment at this point?
Like I said, I think it's the toughest in 30 years. So
how do you get out of this?
Well, I think what we're seeing, so the chief investment officers of pension funds in Switzerland and around the world, it is, I think, the toughest they've faced in 30 years. You're right. Low interest rates, negative interest rates in this country, changing fiscal policies around the world. Very confusing and concerning geopolitics. And so how do you get out of it? I mean, what pension funds chief investment officers are doing, they are globalising. Most pension funds have a very strong home country bias. Switzerland is the same. So they're globalising. They are looking to unlisted assets, not just listed markets, and they're intensely focused on getting fees down and returns up. They're probably really the three big themes that we're seeing in terms of how do they get out of it and try and extract returns for their members in a very tough environment.
Talking about fees, you at IFM Investors, you announced a fee rebate in September. So what's your outlook for management fees at this point?
Well, they are going to go south, and so they should. Asset managers, frankly, have enjoyed positional power and they've exercised that positional power and charged fees that should be under pressure to come down. At the end of the day, it's not our money. We're a manager of the assets. The asset owner is the pension fund and, working people like you and I that are otherwise members of those pension funds. So in a very tough environment for returns, fees are and should be rightfully focused on and they should go south. And, we've got to run profitable businesses because we've got to invest in people. But funds management has been one of the most profitable industries to be in around the world, and
so
that has to change.
I guess a lot of companies could even go bankrupt because of that, depending on the reduction of the fees as well.
Yeah, it will be interesting. It's going to put pressure on a lot of funds managers. So, we're starting to see, read just this morning, a large-scale merger of two big funds managers around the world. The media is suggesting that that's part of the, the consolidation that's going to go on. So. I think there will be a trend to have, a greater focus on returns to investors, less fees coming out of the middle, and that will put pressure on funds managers' business. So if you are high cost, underperforming, misaligned fund manager, you're in a world of pain, and that's okay. But if you're a high-performing, low-cost, aligned manager, then you should survive and thrive, and that's obviously the perspective that we have.
Absolutely. Now, you come to Switzerland quite a lot, especially now that you're setting up a shop here in Zurich as well. In Switzerland, the pension funds, they hold about 1 trillion Swiss francs in assets under management. This is bigger than the Swiss GDP altogether. It's a big sum, but still low returns. What's your view on the Swiss pension system? You know what, it's not unlike the Australian pension system, which is obviously where we're from. We now deal with 19 pension fund investors in 19 countries. So we have a familiarity with different sort of ownership, with different sort of countries' models. The Swiss system, the parallels with Australia is you've got the three pillars of your retirement savings system, as we have in Australia. You have largely a defined benefit system in Australia, in Switzerland, whereas we have defined contribution. So there's some nuances in that. But you're right, you have the pension fund system that is bigger than GDP, same as Australia. The Australian pension fund system is actually now the third largest in the world, and it's 140% of GDP. These two pension systems in Australia and here in Switzerland performing well, or do you think we need a revamp and overhaul of the pension schemes because they're maybe outdated and old school?
Yeah, I'm not sure that revamp is necessary. I think there's a lot of really positive things in Swiss pension funds, the governance of them, the model of them, the implementation of them, and the returns, frankly, that they're delivering. I mean, your funding position as a country is probably amongst the best in the world. A lot of other defined benefit systems have got an asset liability funding gap. That's not so much the case here. So there's a lot of really good things going. Having said that, you know, every business, every individual, every country needs to think about how we go from, you know, good to great, if you like, or just be unrelenting in a desire to get better and better and better. And so we're seeing that in the Swiss pension fund market. We're seeing that around the world. What can they do to really look differently, innovatively, to globalise and access other investment opportunities to move off a strong base and continue to add to their members' returns?
So we can be happy to grow older here in Switzerland and retire in this country. But don't you think that pension funds and the pension industry should also be a little bit more risk-friendly, not too risk-averse when it comes to their investment strategies?
You know, I think that's a fair observation, absolutely, Martina. It's, you know, the liabilities of pension funds are long-term. So there's a real opportunity to really think long-term in terms of the asset. And now with that comes the risk of thinking in a slightly different way. But from our experience, and it's now about 25 years, taking that risk in a considered, analytical, you know, highly diligent manner absolutely has had to return. So, you know, in an environment where interest rates, bond rates, treasuries and the like are zero or negative, you've got to look to take risk, but you know, risk can obviously come with some good rewards as well. So I think, yes, there is, in simple terms, there is a greater need and an increasing propensity to take that risk in a very considered manner.
That brings me to the regulatory framework as well. How do you see the regulations globally at this stage? Do you think we have over-regulated systems, or do we need more regulations? Yeah,
no, look, I am not sure that more regulation is the answer. I think financial services, pension fund systems, different regulations around the world, of course, but in the main, very well regulated, quite stable systems, you know, good conduct and behaviour in the main. There's always things that can be better, don't get me wrong. I'm not sure that more regulation is the answer for the pension fund systems. So, but regulation more broadly, as an investor committing capital to enterprises, be they listed or unlisted, actually does worry us. There is really a theme around the world of increased regulation, increased nationalism, increased nationalisation, and that's one of the worries that we faced as an investor, but less of an issue for us as either pension funds or funds managers. I hope that was clear.
How are the millennials now, you know, looking at their older age? Do you think that they're going to be in a good position? Because it seems that the people above the age of 60 here in Switzerland and Europe, the elderly people, they're a little bit the losers in that game.
Yeah.
What kind of situation will the younger generation face?
I think as a general statement, they will arguably be better off. They're going to inherit wealth. That's not necessarily a great strategy to create your own wealth. Wait for your parents to die.
You can sit back and chill in that case.
So I wouldn't say that's a great strategy. But, you know, clearly there's more wealth and that wealth will be transferred and passed on. So that's one issue. The second thing is more fundamentally, I think that there's many sort of compulsory saving systems around the world in this country and say in Australia where, you know, people, it's now common course. You go to work, you put 9.5% of your salary in Australia into superannuation. So if you do that for 40 years, then particularly with the power of compound interest and diversification, then you're likely to be in a better financial position than what you were before the advent of that system. So I think there's clearly going to be challenges because it's a tough interest rate environment, tough return environment, tough geopolitical environment. But otherwise, millennials are should be in quite a good spot because of, you know, the compulsory nature of many saving systems.
But if you have to give some advice, would you advise the young people here in Switzerland, for example, to make voluntary contributions as well for their old age?
In simple terms, I would, but I've got a 28-year-old and a 24-year-old daughter, and I know how that advice goes down in my household when I offer it to them. But having said that, they've got their superannuation account, so that's good. So, but I think generally speaking, I mean, you're only young once. So enjoy yourself, right? But at the same time, it's disappointing how quickly you get old as well. So setting yourself up for that financially is a sensible thing to also do. But it is a balance.
Absolutely. Now, as we mentioned, you have some 80 billion Swiss francs in assets under management. When we look at the global economy, we see very strong growth in the US, a little bit of a different picture here in Europe. Where do you see the biggest growth markets for you at this stage?
Yeah, well, so we've got a global portfolio, so we're looking at primarily at developed markets, I must say. So we're looking less at emerging markets, but that's more about the skill set that others have. Back to your earlier question, I think there's other people that are more skilled and experienced in emerging markets. So we're more focused on developed markets. So where do we see the growth? I mean, I'm sorry to be so trite, but we really do look at it more closely at an individual security level, whether it's an infrastructure asset or a listed asset. So, all up, we're relatively optimistic about the outlook for world growth. There are clearly some growth coming off, particularly in Europe. There are some uncertainties with Brexit and the like, but having said that, we think that broadly the outlook for growth. But then we look through that at the individual country, the individual security, and very closely assess it on that basis.
We've briefly talked about China before we started this interview, and it's difficult and tough for foreign players, especially in the pension funds industry. So China is a no-go for you at the moment?
Look, there's a couple of things about China that are probably relevant to us. I mean, the first thing is that we're a very large owner of airports around the world. We're the largest owner of airports in Australia and an owner of other airports. So China, 200 million people. Transferring to middle class over the next 15 years.
It's an opportunity you could not miss, right?
Well, they're getting older, they've got more money, and they're retiring. And they're using that time and money to fly, to travel. And so, we look at the strategic implications of the macro and the demographic shifts in China. And so we think it's a great time to be an owner of airports, for example. In terms of investing in China, we keep a very close eye on it, but they're not short of capital. Right, so the question for us is, why and when and how do they need our capital? And we've got less experience. Great respect for the country and for the rule of law, etc. But we've had much greater exposure, experience, and comfort. We're still getting good risk-adjusted returns in Europe, in the United Kingdom, in the Americas, in Australia, of course, and in parts of Latin America as well.
So you're just waiting for the window of opportunity, and of course, Australia is a big trading partner for China as well. Let's talk briefly about Brexit as well. And you've previously said that you see a lot of infrastructure investment opportunities, but with the scenarios that we're seeing out of the UK at the moment, what's your take on the investment opportunities there?
Well, clearly, I mean, it's every day the perspective changes, right? So
you can't really make a calculation there. It's one day this and one day that. So
it's getting closer and closer. So what is our perspective? There's clearly a range of different scenarios. We've just recently invested in the M6 tollway in the United Kingdom. So that was post Brexit being announced. That gives you some indication. Now, we're still concerned and we're still keeping a close eye out. But having said that, as an economy, we still have confidence in the long-term success of the United Kingdom. And so whilst Brexit is potentially unsettling, the likelihood, whilst it's still possible, the likelihood of a really harsh Brexit where, for example, planes don't fly is a possibility, but in our view, not a great likelihood. There'd be massive economic consequences for that, and there doesn't seem to be a whole lot of political rationale as to why anybody, European or UK, would do that. So we are keeping a close eye out, watching it as closely as we possibly can, but overall, long-term confident about the sustainability and growth in the nations that are most directly affected.
With these multi-layer risks and risks on different fronts, how do you actually build your risk hedging strategies?
Yeah, well, with a whole lot of analysis and diligence. Our investment committee papers really look at a range of different scenarios. If you're going to buy a seaport for 90 years, what's the effect of global warming? What does that do to sea levels rising? What does that do to your port? What does it? So we do extensive analysis. Is the key answer and try and economically assess the impact of different scenarios and then ultimately form a base case.
And you must be using a lot of AI and machine learning as well to
All
face some of
sorts
these complexities,
Absolutely,
right?
yeah. But the other mitigant to some extent is diversification. So buying assets that have got diverse ports, imports and exports, grains and hard goods, finished goods and raw materials. So we look at diversification within assets, then we look at diversification across portfolios. We do a whole lot of diligence. But the other thing we do is we have a long-term time horizon. We have a long-term time horizon because things will inevitably not go to your plan, but hopefully, whilst it might be a little bit of a ride like that, it'll go in the right direction. So, but a long-term investor, whilst we'll be prudent and analytical, can afford to ride through some of those cycles and frankly, buy into them if you want to be prepared to back your judgment. And, in our case, got 320 institutional investors that also afford us the luxury of investing long-term.
Well, looking at your portfolio allocation, you're really heavily invested in infrastructure, debt and equity as well. Will you, in that case, maintain this focus, or are you planning to shift somewhere else?
So our clients make the asset allocation decision, the pension funds. We then, once they decide to go into infrastructure equity or debt or listed equities, we'll put our foot forward and hopefully win the opportunity and earn the right to manage some of their money. So it's the asset allocation is more their decision. At the moment, our business, IFM, is around about a third infrastructure equity, about a third debt, and about a third listed equities. And we also have a commitment to and a capability in private equity, which is a little less than a third. Yeah.
So what happens in case you don't agree with an investment decision by one of your clients, by one of the pension funds, and you think it's too risky? What do? You have to go with the flow and agree with your client,
that's a really interesting point because one of the challenges is that there's a lot of pension fund investors that are allocating money to infrastructure equity and infrastructure debt, and we're very clear with them on what the risk and return attributes that we're looking for. So we will sit on the sidelines if we can't find things to invest in. It comes back to our ownership. We've got no driving need to put the money to work to get fees as a business. Our driving need is to get returns to our investors. So we're very clear with our investors. If they allocate money to us and we can't find opportunities, we will sit on it for a while until such time as that opportunity presents itself. And frankly, for many investors, they're very encouraged by that.
A lot of pension funds also going to impact investments these days, sustainable finance. Where do you see the biggest opportunities there?
Yeah, look, there's various terminologies or definitions around impact investing. We describe ourselves as a very active manager once we buy securities. So some people call that impact investing, but particularly in infrastructure equity. If we buy an infrastructure equity enterprise, we intend to own that for a long period of time.
And what kind of due diligence do you have in terms of making sure that it's environmentally and socially and governance friendly?
It's a huge part of what we do because our clients rightfully expect it. But more importantly, we fundamentally believe that an enterprise that has a mind to E, S and G is ultimately going to be a more valuable enterprise. So what we do is we make sure we take significant enough positions to get a board seat, so as we can influence the strategy of that enterprise and we can make sure that there's a focus on labour rights, on workers' safety, on environmental emissions, on the governance. And we think, whilst we do invest in some businesses that are, say, less higher carbon emitters, what we do is we have an objective at a portfolio level and at an individual enterprise level to get those emissions down. So we're transitioning some coal-fired to biomass. So the CO2 emissions are going from here to here to here to here. So we'd argue that and that's clearly means that we've not only got a cleaner environment, we've actually got less costs of energy. So it's really good for the enterprise, but it's really good for the environment. So we're very active, some might say impact, but it's very active owners of assets to ensure that we improve the value of that enterprise through an ESG focus.
Brett, before we go, when we look at your expected returns for this year compared to last and expected return growth in 2019, where are we heading?
So, sorry, I don't mean to duck and weave from your question, Martina, but infrastructure equity, infrastructure debt, listed equities. If I was a pension fund with a whole range of those asset classes, unfortunately, I think that the returns that people are looking at, absent a globalisation, absent a greater exposure to unlisted assets, will come down. People have got to look carefully at the domestic versus global allocation, the listed versus unlisted allocation, and look very carefully at those fees. So as there's more going into the members' account.
Brett, thank you so much for your time and coming from down under to Switzerland. Thank you so much.
Pleasure. Thank you, Martina.